Welcome to our monthly property and credit market update. If you have watched our recent updates, we have talked about the cyclical floor on house prices driven by strong population growth and low unemployment. You will also have heard us speaking about diverging outcomes starting to appear across markets as the impact of higher interest rates is felt. These attributes are continuing, which we'll explore through this update. But firstly, let's take a moment to unpick the current state of the market. At the end of May, the total stock of residential housing in Australia was valued at 10.7 trillion, with around 452 billion in gross sales per annum. This sees about 1/5 of our 11 million dwellings turnover each year. We have a market which represents a large portion of Australia's overall wealth. At the most macro of levels, it is not overly geared, and it is an open market with ample opportunities to buy and sell. Since the COVID lockdown period, property values have multiplied. Smaller capital cities of Perth, Adelaide, and Brisbane have increased by around 60%, an astounding amount. Canberra, Hobart, Sydney, and Darwin have increased in the 25 to 30% range, followed by Melbourne with a relatively weaker result, still having grown by 11% since COVID. It might be easy to blame lockdowns and a weaker economy in Victoria for its lower growth, but that is unfair. Victoria has been adding around 10,000 more new completed dwellings annually to its market than New South Wales over the last few years, and has consistently been growing its stock by far more than the other states. Unfortunately, it's not enough. Existing stock coming onto market plus new stock being introduced continues to fall well short of demand. Last year, we grew our population base by over 650,000 against new stock coming onto market of 300,000. In the coming years, dwelling completions will likely stay subdued, but population growth is expected to stay elevated, even if it does tilt back towards what is historically more normal. So, the trend of increasing prices is continuing. House prices are up nationally, 8.3% per annum in the 12 months to June. Capital cities are growing. Regional prices are growing. Let's now turn to my opening remarks. Diverging outcomes are starting to appear across markets as the impact of higher interest rates is felt. But it's not divergence across different locations. It's divergence across different price points within markets. Housing is expensive. The cost of servicing debt has increased as interest rates have risen. Therefore, it's no surprise that expensive houses are not growing at anywhere near the rate of lower-priced homes. Across Melbourne, Brisbane, Adelaide, and Perth, it is the lowest 25% of dwellings that are growing the fastest. In these markets, the more expensive properties are only growing at around half the rate. In Sydney, the highest 25% of values are barely growing in price, and in Melbourne, that same cohort is now starting to go backwards. But what does this tell us? It tells us that core stock of lower-priced property continues to show its cross-cyclical resilience. It tells us there is a broad and wide market of people wanting to enter the market or enter it at a lower price point since the cost of carrying debt has increased. And it tells us that while property will continue to be cyclical, the underlying market has a floor to protect against any immediate and significant fall in prices. Thank you for watching.